Hello, I'm Robert, and welcome to my channel, where I discuss everything automated algorithmic trading, or simply algo trading. Today's going to be a follow-up video on a couple of items. Let's get started with a look at the live Euro USD market and my actual positions on the right-hand side. These are what I am holding right now, using my floating grid technique. Now you'll notice that the unit sizes are small, and I've talked about this before, in that this is a passive system. It's meant to weather the market and to be able to handle situations of extreme market volatility. And when you look at individual candles, you can see the high and the low at the bottom here, where you get the idea of the range. Now for the range of the market that I am looking at, my grid is established at roughly 500 pips. And you know what your pip range is by taking your high and subtracting your low. In today's market, we see a high of 1.05304 and a low of 1.04186. So let's just shorten this up. 530 minus 418, you're looking at about roughly 80 pips today. Not a bad market. But realistically, when you're trying to figure out how much to give your room for your markets to breathe before you take stop losses, it's trial and error, and every market is different. You need to run your demo account. You need to focus on testing. Those are extremely critical. But today, I want to talk about specifically one particular aspect of this market that I've discussed before. And it doesn't happen all the time, but when it does, it's important to pay attention to. And that is the gap. As we can see from this black region in between two orders, the orders aren't uniform in this region as they are above and below. Gaps are a way of showing extreme market volatility. And in this case, this gap went against me, as I didn't get this area filled with orders. When gaps go in my direction, I sell off large order numbers at one time. And that's great, because that brings home generous profitability. But nonetheless, gaps are a devil's sword. They're wonderful and they're a curse at the same time, depending upon the market structure you are trading on and the direction of the gap itself. The big problem that I have with gaps, that I see a lot of traders trying to do, is they try to chase the gap. And that is disastrous. You cannot chase something as unpredictable as these unusual price spikes. But yet traders try it, and it causes massive amounts of losses. I personally find that using the passive method, being able to simply let the market flow on its own in equal intervals, that I trade more consistently and better, even if it means lowering my position sizes to ensure I have enough liquidity in my budget to handle unusual market shifts, as what we see in today's market and previous markets in general. But while we are looking at this region, we need to pay attention to how reduction is working. This was at 160 units. the very last trade right above the yellow line. I am now down to 93 units where I have taken and sold off 67 units. Those units are a direct and deliberate loss. That loss guarantees that I take my positions into account on my terms. You cannot avoid losses. It's simply impossible. What you can do is decide when you will take a loss deliberately. Reduction technique, which I have described before, is the way to manage a loss for every single successful trade. Now, this isn't just a willy-nilly or a hara-kiri approach. There's actually a very strong mathematical principle behind it and how I achieve how much I want to actually take at a loss. As you can see on the left-hand side, the circled number of a minus 0.1, a 1 penny loss. But right below it, you see I made a 10-cent profit. So my net for this trade is 9 cents. My ratio is a 1/10 loss. So for every 10 trades, or for every 10 cents, I take a 1 cent loss. So if I was to trade 1,700 units, then I would scale my reduction equal to my profit. By keeping my reduction in balance with my profit, I am keeping my entire grid process stable. Because if I had 1,700 units and I'm only burning off 1 unit at a time, then that means I would have to burn off 1,700 units to get rid of the lowest position. But by multiplying my reduction appropriate to my profit, that I'm keeping that equilibrium such that I can maintain the stability and the duration of my trade in relation to the reductions. So if it takes me 160 times to burn off a single trade, if I scale up, it's still going to take me roughly 160 times to still burn off my oldest position. This is incredible. This is critical in the point of view that you keep your relationship approximately equal in terms of your losses to profits, because it gives you a consistency that you can extrapolate against any budget. So what that would mean is if I scaled up a factor of 10, I'm looking at a dollar profit and then a 10-cent loss. If I scale up a factor of 100, I am looking at a $10 profit with a $1 loss. So that no matter what my actual unit size is in relation to the trading, I am maintaining this consistency that guarantees I have an easy way to calculate and estimate my profitability on a long-term positional scale. That is one of the most significant aspects that you need to really focus on in relation to setting up your trade and using reduction. You need to find the balance between profit and deliberate loss that fits with your risk assessment and still keeps your grid floating in a fluid enough manner to cover your worst case scenario. In my situation, my worst case scenario is 500 pips. That is before I take a hard stop loss. But by using reduction the way I do, I try to mitigate that hard stop loss as much as possible, which helps me maintain a healthy profit basis. As I've demonstrated within the support server countless times, not having reduction causes some serious, brutal, and painful losses. But having the reduction clearly has a benefit where I've demonstrated between two identical counts, where the reduction kept one account in pure profit, while the second account without the reduction was decimated. Figure out your trading risks, and then figure out the scale between the profit versus the loss, and work to maintain that scale. And you will be able to go and build a reasonable and efficient trading process that will weather market shifts. Now let's back out of this market and look at a bigger picture. And we can see where the market has been and the actual range I am studying between the yellow lines. This range really is quite elaborate, but we can see it's in a bearish cycle, potentially at the bottom of that cycle. We can see we had a small uptick here before the market continued down from where it started. Whether or not we continue that process at the bottom over here really doesn't matter if you've made your trading process able to weather any market safely. That really is your second consideration, is being able to stay in the market consistently, even at smaller aggregate levels. Remember that the whole point of the floating grid system is to be passive. It's not meant to be an aggressive profit system. It's meant to be a passive profit system. It's never going to make as much money as an aggressive system because it doesn't take on the risks needed that an aggressive system does. That is critical to understand in terms of how you develop your trading. As we continue to look at the profitability, we see the loss and we see another 10 cents of profit. Again, demonstrating how I'm maintaining that cohesion between my profits and losses, that scale. Here we see something slightly different. The 1 cent, but only 9 cents of profit. Yes, slippage is real, and this is an example. This is an example of where slippage came back and took away a penny of profit. But at the same time, that slippage could have gone in my favor, and I could have made profit. For example, here, we see an interesting situation where I have slippage go against me, but at the same time, I have slippage going for me, where I ended up taking a 2-penny loss, but I made 11 pennies. So that kind of balanced out this trade to maintain my 9-penny average profit. Here we see a negative loss with a 10-cent profit. The same thing here. A 2-cent loss, but only an 8-cent profit. Volatility really cut into my profits, causing me a 1-penny loss, but an additional 1-penny loss because of the reduction. So the net for this particular one is only 7 cents, but it's still a profit. Let's see if I can find a really generous. Here's one that really got brutalized. A 2-cent loss. Let's try that again. A 2-cent loss and only a 7-cent profit. So I only walked away with 6 cents of profit between this trade combination, where the volatility really went against me aggressively. Okay, and it looks like this morning has been brutal for volatility. There are a few holdouts where I got a nice 1-cent boost here, which is nice. Volatility in this case went in my favor. So let's see what else I can find here. But as you can see, you're really looking at a very consistent approach. And that is the whole point of this entire process. You want consistency, whether the market is going in your favor as it is here, or if the market goes against your favor as it did here. Here the market went against me, and it really brutalized a lot of my profits. But because of the reduction, I didn't have to worry about stop losses, because it was within range of my entire grid. And the reductions kept my grid moving as the market moved hard against my positions. So hopefully this will help bring more clarity in terms of why reduction is such a useful tool. And I will link the first video, or try to remember to link the first video, to the bottom of this one. But there are numbers of different videos where I talk about the equity curve, where you see little barbs in it as this takes those losses. Now for the second part of the video. The second part of this video is going to be a follow-up of the potato harvester strategy that I discussed in the previous video, From Zero to Profit, the secret of the potato harvester trading strategy. So here we see exactly what I'm doing, where I have 4 different alerts. The first alert is $10, the second alert is $20, the third alert is $30, and the fourth alert is $40. Now I'm using a simple 1% take profit, and this is a spot market. So I'm using an opportunistic sell, but a hold principle in the intra. Because it's spot, I don't have to worry about margins, liquidation, decay rates, or anything of that nature. I can simply let this run and wait. And that's what I've done. But from the first video, where I took over 1,100 trades, I completely reset everything, threw out all that data, and started over. Yes, you heard me correct. I started over. That's what you have to do in algorithmic trading. You just can't accept one test or one analysis as a working system. You have to go through repeatedly processing trades over and over to verify that you just didn't get a lucky market. Realistically, I have done just that. I have proven that this wasn't luck, because for the second market, I took 506 trades. For the month of September, I made $5 because I started at the end of September. In October, I made $49, and so far for November, I've made $83, all within a rough budget of about $3,000 to $3,500. And you can see that I have a total of $138 for 506 trades. And no stop losses because this is a spot market. So I'm simply holding and waiting. My average profit per trade is roughly 27 cents. And I average about 168 trades a month. My average monthly profit is $45. Now, my VPS is $24, so I've not only covered the price of the VPS, but I've also covered and gained a little profit. So overall, this technique is successful. It's doing what it's supposed to do and is making money in a real way. But let's go further. Let's actually see how many trades per day this particular strategy was capable of doing. The red lines are buy signals. The green lines are sell signals. And you can clearly see where the average is, which is roughly in this area. And then you see the high volatility days, both in buying and selling. My biggest buying day was about 26 trades. My biggest selling day was about 28 trades. But you have a good basis of market volatility by looking at the number of trades per day this kind of a strategy is capable of making. Now let's look at the equity chart and see how the profits really kicked in. And you can see a couple of areas that look like volatility spikes. And in fact, they are. When you see the market moving steady and then sharply increasing, that is a volatility spike. Meaning I had positions and those positions were quickly sold off. That's what we like about volatility. It can do very well in pushing your profits quite generously. When it works against you and causes gaps, that will cause a reduction of profitability simply because those orders don't exist when it comes time to sell. But it's not a big deal. As you progress in your testing, you see clear evidence that your strategy works in different market conditions. That is the sign of a reliable strategy that will weather the market in general. So by using this approach, by being able to actually go through and study the market in such a way, you are able to learn the dynamics of that market. Matic is a unique market in that its dynamics are very clear, as we can see on the chart. Well, once TradingView gets done with its games. We can see just how the market looks at each of the levels of the potato harvester. And you can see where the different markers kick in for buying and selling at different levels. The green is the lowest level, which is of course the lowest level of volatility, within the range of this market. So as you progress and you continue to look at your markets, study them carefully. Look for the little details that help you make decisions. Let me know what you think. How has your trading been going? Have you been getting gaps that have been going in your direction, or have they been going against you? Let me know. What do you think of this market now that Bitcoin has made a new all-time high? If you're not subscribed, please hit that like button and subscribe at the bottom of this video. If you want to help support this kind of research and work, please join my Patreon. The link will be in the description below. At the end of this video, I will have a link to the first video talking about the potato harvester. It really is a wonderful tool that can bring in some very interesting results and profitability. Thank you for watching, and until next time.